Welcome to the Wealthwise show, where financial wisdom meets the road to prosperity. Get ready to embark on a journey to make wise financial decisions and unlock the secrets to building lasting wealth. I'm your host, the Wise Investor, and just as a disclaimer, go get some compliance out the way. This podcast is intended for educational purposes only. It is not intended to be tailored personal advice, because I don't give personal advice on the internet. So keep that in mind as you continue to listen to this podcast. That is for educational purposes only. And if you hear a product like a service or a company, anything like that, I'm not endorsing them unless they're sponsoring the show. Well, then it's an endorsement. So just keep that in mind as you get into today's episode of the Wealthwise Show. Alrighty, guys, another week, another episode. This episode 14. Well, first of all, welcome guys to the Wealthwise Show. I appreciate you guys allowing me to talk to you. I don't know why, but I appreciate it. This is episode 14, and before I go into the title and what I'm going to be talking about, let's get some compliance work out of the way. Keep in mind, guys, this podcast, me, the Wise Investor, this podcast is for educational purposes only. It is not meant for you to use this as your personal advice, because this is not personal advice, because I don't know you. Unless I do know you, then you really should just talk to me in person or email. So keep that in mind, guys. I don't know you unless I do. And if I do, this is still not advice, because you should be talking to me for said advice. So this is for educational purposes only. It is not meant for you to be used as your personal finance. Please talk to your fiduciary or your financial advisors to, double check the information I'm saying. And please do your own research. Understand that what I'm saying is just one person. And the world of finance is the world of finance is 1,000 years old. So I only know a little bit, and I'm giving you a little bit, but there's a whole world of finance professionals out there who know way more than me. So don't just take what I say as fact. Go research it. Go do your Googles, Investopedia, talk to your own financial advisor, and, come to a conclusion that is right for you. So with that out of the way, today I want to talk about ETFs. Now, I did an episode about ETFs early in my career, maybe like 12 episodes ago, 11 episodes ago. And this is not that. I'm not talking about ETFs and mutual funds. Well, technically I am, but I'm talking about the expense ratio for these products, which a lot of people don't know. And a lot of people don't calculate that into their investment expenses, because there are expenses when it comes to investment. You got commissions, which a lot of people have commission-free brokerages now. You have, your management fees if you have a money manager or a fiduciary. You have not just commissions on like buying stocks or shares or things like that. If you buy life insurance, there's commissions on that. Now, granted, you might not pay that. Your insurance company might take whatever you give them and use that as a commission, but it's still something you should think about. And the reason why expense ratios to me, is to talk about. The reason why to me is important to talk about is because, I see a lot of people talking about, hey, this ETF, that ETF, this ETF, that ETF, and they have a portfolio of 1,000 ETFs, and each ETF have their own expense ratio, or mutual fund too. So what is an expense ratio and why it's important? And you should do the math, especially if you have a large sum of money. So a large sum of money to me is anything over $1. So if you have more than $1, you should really probably think about the expense ratio. So when it comes down to what the expense ratio is, well, it is what it is. It sounds like it's a expense ratio. So it's pretty much how much it costs to, you know, have that fund because they have expenses. You know, I'm a fiduciary, so if I charge you a percent of assets for you to use me, well, guarantee I'm not getting a whole percent. You know, because I got to pay the firm that I'm with, I got to pay taxes, I got to pay marketing, I got to pay basically there's a bunch of stuff, expenses. So don't think that these people are just doing this for fun and for free. That's not the case. Unless you personally own the individual stocks, if you own an ETF, you're paying for that management, because especially if they're more active and they're rebalancing and all that stuff, someone's doing that. So therefore, factor that in. But the reason why a lot of people don't talk about it, because typically the expense ratios are pretty small. When I mean small, like, less than a percent, way less than a percent, less than 0.5%, less than 0.25%. If you got an expense ratio at, 0.30%, that's pretty high. So most expense ratios are really low, but the thing that people don't factor in is large numbers. So let's, for example, I charge 1%, really 1.54, because I have a firm that handles a lot of the office work that they take that percentage. So let's say I do my fee, and a client comes in with $100,000, and they say, hey, I want you to manage this for, and what's your fee? I say 1.54. Oh, that's not too bad. That's only, $1,500. Of course, it's more than $1,500. I'm not doing all that in my head right now. This is an analogy, so don't expect perfection. But let's say it's $1,500, and they're like, okay, that's not too bad. Great. All right, that's doable. But then let's say another client comes in, and they say, hey, man, I got $10 million. I have $10 million, and I would like you to manage said $10 million. And I say, oh, sure. That's going to be 1.54%. Well, guess how much that is? $154,000. Now, to you, you might say, well, that's not terrible. They got 10 million. But let you win a lottery or you win a settlement and you get $10 million, and someone says, hey man, let me go ahead and get 154,000 off of you and tell you what to invest in. It's expensive is what I'm saying. So when you're dealing with larger numbers, that 1% or that 0.03% or that 0.05% or that 0.10%, that adds up really quickly the more money you make. And as you appreciate in that ETF, well, guess what? That's more money in the ETF, meaning you have to pay more. And when I say pay more, I'm not saying you have to pay a higher percentage, but laws of big numbers are large numbers. And so that's why it's important. So if you got a little few dollars in there, you might not be stressing out about your expense ratio. But if you had a good year in this year, or you had a good year in 2020 and 2021, and you put in the market, let's say 50,000, and now you a cajillionaire, well, you might need to start thinking about expense ratios. And they're on all the ETF websites. Is in the prospectus. What's a prospectus? Oh, that's a big word. And that's a word that a lot of people don't throw around because they don't know what it is. So a prospectus is essentially the information of said, if you IPO, if you go on an exchange, you have to have information for the people buying your shares if you're in the fund or, investing in your company. So that's what a prospectus is. It is just an information sheet or information booklet or sheet, whatever, to tell you basically what is it that you are purchasing. And a lot of people, who are on YouTube, Twitter, Facebook, Instagram, a lot of people who claim to teach financial literacy and financial education, they do not tell people to go look at the prospectus. And the reason why they don't tell people to go look at the prospectus, because they don't know what a prospectus is. They probably thinking this is some sort of, government agent, the prospectus. He's going to come in and, audit your assets. I don't know. And no, it's literally just an information sheet. And it's important because if you are involved in a ETF, they're going to have that information in there for you. Or you can just look it up too. I mean, Google is your friend. Google will pull that information up too. But if you're one of those people who just want to read a little bit more about, what you are involved in, well, go get the prospectus. By law, they have to give it to you. And more likely it's on the internet now or sent through an email. So you're not going to get a physical copy, and I think unless you ask for it. But anyway, back to what I was saying. Expense ratios. So basically, if you want to know about the components of this expense ratios, is pretty much the management fees, the administrative costs, and the operation expenses. And so like any business, that gets passed down to the person who is in there. And a lot of funds typically have this fee, mutual funds, ETFs, index funds, but they might have different expense structures. So just keep that in mind. And the reason why, there is an importance to getting a ETF or a fund that has a low expense ratio, but maybe just don't look at only the expense ratio, because sometimes you get what you pay for type of deal. So me personally, I'm not gonna say no names because I'm not endorsing nobody unless y'all want to sponsor. I'll be down for a sponsorship any day. Then I will name you every 5 seconds, and be like, hey, get this. So like I was saying, and then blah blah blah, and get this, and then But anywho, the importance of having a low expense ratio is important, but it's not the only. It shouldn't be the deciding factor. So there are index ETFs that have, the big boy index ETF and more of a low expense ratio ETF, but it still follows the same index and it pretty much still follows the big boy ETF. So you pretty much getting that same movement, but with a lower share price and a lower expense ratio. So if you're just let's say you just found an ETF with a low expense ratio, that don't mean it's great. You should still look into it. Look at the prospectus. I just like saying that. Sorry. And find out, what they're investing in, what their investment strategy is, and see if that fits you. But if you're just going with an index, find a low expense ratio index is typically okay. Like I said, this is not advice for educational purpose only, so I'm not telling you to go do that. But it is something you should look at, because sometimes some fund performances are, even though they might be tracking the same index, may be different. You might say, well, they're tracking the same index. How may it be different? Because they might be ran by different managers. They're tracking it. And some people tracking skills are not as good as other people tracking skills. I'll tell you that much. But if you are someone who is building your wealth and let's say you inherit some money from a life insurance policy or something like that, this is why it's important to talk to a fiduciary, and it's important to talk to a financial advisor, because they can help you find what you're looking for when are at a low cost. So if you came to me and say, hey man, I have this X amount of dollars and I hear everyone talking about this index ETF over here, and they keep saying invest in this particular index ETF, and I say, hey man, that particular index ETF is like 0.10%, and they're like, okay, but this person that is well known, they keep talking about it, should I do it? And I say, well, how about this? Let's go with this index ETF, and you're going to get the same performance but a lower expense ratio. So having someone who is professional, who can go through that with you, is important, because like I said, the reason why I say I'm not giving advice This is for education purpose only because I don't know your situation. I don't know you. Like I said, a lot of money to me is anything over $1. So a lot of money to you might be anything over $1 million. I don't know that. So to me, I'm going to go with, what I feel like I can afford. And if I don't know you and I'm giving you information, I don't know what you can afford. So that's why if you're just blindly, not saying you guys are, I'm not saying that. But if people are blindly just listening to people and not questioning and not doing the research and not asking questions and not talking to professionals and not talking to just one professional, a few professionals, then you are pretty much allowing anyone to come in and manage your money, because allowing someone else to do it without knowing anything, without them knowing anything, is just a waste of money. So that's pretty much, I don't know what the time it is. That's going to be pretty much for this. There is a bunch of other stuff I got on my docket here, but it's pretty much regurgitating the same thing. I wrote an outline for like a bunch of episodes. Here's another one, tips for investors. So research and due diligence. So understand what I just said. Understand thoroughly research expense ratios and understand their impact on long-term returns. Nice pass, Derek. Nice pass, Derek. By the way, that's my name. And long-term mindset, So, advocate for a long-term investment approach and how low expense ratios can contribute to a better outcome, which is true. And don't forget, a lot of ETFs, especially index ETFs, do their own rebalancing. And what is a rebalance is basically, let's say you have X amount of dollar in stocks and X amount of dollar in bonds and X amount of dollar in real estate. And this is, the set allocation you have. But then let's say the equities or stocks dip, but bonds went higher. So what you would do is to rebalance is take a little bit from the bonds and put it back into the stocks to get you back at that appropriate allocation. And, that's basically where rebalancing is. And a lot of ETFs do that themselves, so therefore you don't have to. So let's say you own, all these companies and you're trying to rebalance them, you don't have to do all that. The ETF does that for you. That's what their expense ratio is. You're paying them to do it, so let them do their job. So you don't have to worry about rebalancing. So that's going to be it. Just keep in mind, just as a recap, expense ratios are important, especially when you're dealing with the game of large numbers. Keep that in mind. $1 versus $1 million at an expense ratio of X can be greatly different, and unnecessarily different, meaning you're probably just spending money unnecessarily because there are other options. So thank you guys for tuning in. I really do appreciate you guys' support on this journey. 14 episodes in. Hopefully I sound like I'm doing a lot better, not as nervous. I don't know why. It's just me in my room. I should be outside. It's the weekend. This is kind of pathetic, but it's okay. I love finance, and therefore I'm doing what I love. So I appreciate you guys' support. Keep supporting me. And by support, I mean, listening. It's free of charge to you. Of course not free, because you're paying for these services. But I appreciate you paying for these services and listening to your favorite artist while you listen to your favorite new podcaster. Thank you guys. This has been great. The Wise Investor here. And until next time, guys, stay Wealthwise. Investment advisory and financial planning services offered through Simplicity Wealth and SEC Registered Investment Advisor. Sub-advisory services are provided by Simplicity Solutions, LLC, a registered investment advisor. Any insurance, consulting, and education services offered through The Wealthwise Show. The Wealthwise Show is not affiliated with Simplicity Wealth and Simplicity Solutions.